zero-day trading, the risk resets every single day. You don't get that buildup of leverage over, period of days, weeks, months, or over a course of a year. So when you talk about like Volmageddon and leverage, it's a very different, environment and scenario now versus what we saw in 2017, 2018.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everybody. Welcome to the latest edition of IBKR Podcasts. I'm your host today, Steve Sosnick, Chief Strategist here at Interactive Brokers, and I'm thrilled to have as my guest today, return guest, Mandy Xu, Head of Derivatives Market Intelligence at the Cboe. Hi, Mandy. How are you?
Hey, Steve. Thanks for having me back on.
It's my pleasure. I enjoyed our conversation so much last time that I'm glad we were able to do this again.
Yeah, likewise here.
Yeah, exactly. Well, let's just jump right into it. When we look at markets, the bond market is saying one thing, particularly in terms of volatility. The stock market is saying something else. When we look at something like the MOVE index, that's definitely getting more elevated in recent sessions. By the way, just so everybody knows, we're taping this on Thursday afternoon, December 7th, in case you're listening to this later on. But since the start of December, we've seen the MOVE index really leap higher while VIX just remains in the doldrums. I'd love to hear your thoughts on that, Mandy.
That's a great question. And I think, especially coming off of a month like November, where, everything kind of rallied together. We had this historic rally in bonds and equities and in credit across asset classes. The divergence we're actually seeing in the volatility markets of these various asset classes, I think is very interesting, right? So like, as you pointed out, on one hand, we have equity, and I would also put credit in the same camp where volatility has just completely collapsed, right? VIX went from, the mid-20s in October to a low of 12. Same with credit volatility. If we look at our, credit VIX indices, investment grade VIX IG, as well as high yield VIX HY index, both fell by over 50% in November. So those two asset classes clearly kind of in the more bullish camp in terms of what they're pricing for risk. And then other hand, you have the bond market MOVE index. It did decline in November, but very modestly. And as you pointed out, in recent days, it's going higher. So what's going on? To me, the divergence is really around kind of the shift in the consensus expectation for Fed policy, but also the persistent uncertainty around that expectation. So what do I mean? So over the past month, markets have clearly gotten more comfortable with where rates are and where the Fed's about to go, the expectations of potentially Fed cuts as soon as March of next year. So the modal expectation for Fed policy has certainly gotten more constructive for risk assets such as equities and credit. And I think that's, part of why those asset classes rallied and volatility have declined. But, the uncertainty band, right, around that expectation is as wide as it has ever been. Yes, we can definitely see a situation where we're headed for a soft landing. The Fed starts to cut rates if inflation remains low. But there's, also a scenario where inflation, core inflation starts picking up higher, or, if growth actually falls even more, right, the Fed could cut even more severely. So that uncertainty band around Fed policy and the path of policy rates is extremely wide. And that is what is driving interest rate volatility, higher and why it has remained extremely elevated throughout this rally. So to me, that divergence is significant in that sense. It tells you there's still a lot of uncertainty regarding Fed policy. But the other divergence I want to highlight, maybe that's a little bit fly under the radar, is also what we're seeing in the commodities market with oil, right? And, one asset class notably that didn't participate in the rally in November is oil prices actually fell, and oil volatility remained very sticky during that period and did not participate in the decline that we saw in equity and credit volatility. Yes, part of the decline in oil prices you can potentially attribute to, dissipating geopolitical risk, supply issues. But I would say, oil prices near 1 year low signals concerns around the growth picture, the outlook for growth. And you contrast that again with equities and, the rally that we saw in November, very much led by cyclical stocks, right? Small caps, outpacing large caps, value outpacing growth, cyclical stocks outpacing defensive. That's very much an equity market that is positioning for pickup in economic growth rather than potential downside concerns. So to me, these divergences, in asset class volatility, asset class performance, really just kind of highlights, still the very elevated uncertainty around the macro outlook.
There are times I wish we disagreed more because, I'm sitting there nodding my head. Obviously, the listeners can't see that. But my thesis has been, and I wrote about this over the last few days, is that the bond market and the short-term fixed income expectations are reflecting probably a hard landing. Since the last Fed meeting, so I did this from November 2nd, the day after the Fed meeting, the last FOMC meeting, we've pushed up expectations for rate cuts by 2 months, from June to March. Mm-hmm. We're about 75% in June before, now about 75% in March now. And we've come from 3 cuts in 2024 to 5 cuts in 2024. That is not a soft landing. That's a pretty hard landing. Stocks seem to be, ignoring this prospect. And as you say, when you see like the Russell taking off, which are the most economically sensitive stocks of them all, it comes down to, are stocks just sort of, one of the questions I asked basically is, has the stock market front run Santa Claus? They're just so content with what's happened before that they're really willing to overlook some of the quote the known unknowns, including we're taping this before the payrolls numbers and the FOMC meeting. And I'm looking at something like VIX 9D, which, I obviously you're familiar with it. I'll let you explain it better than me as the Cboe representative. But even the 9-day volatility expectations, as opposed to the 30 days incorporated in the main VIX product, are not really showing much concern ahead of these events.
Yeah, I think, to your point, I think short-dated volatility, whether you look at 1 month, 1 day, 9 day, you pick your tenor. Those volatilities have clearly fallen. I think they've fallen because, we're not going to know this whole soft landing versus recession, hard landing. The outcome is not going to be clear anytime soon, right? It's going to be sometime next year where we're going to look back and say, okay, yes, it's one way or the other. And that's why actually the part of the volatility curve that it is reflecting more risk, it's longer dated tenors, not shorter dated. So, VIX 1 day, 9 day, 1 month, all the short dated tenors have fallen. But if you look at 1 year implied volatility in the S&P, right, that spread relative to, say, the VIX, it's near the highs. So that tells you people are still, concerned over the longer term outlook. And it's just not being reflected in a short dated measure such as the VIX. But one thing I do want to kind of maybe touch on, you talk about the kind of the rally that we've seen in November. I do think part of it is positioning related. Yeah, yes, part of it is fundamental, right? Like the better than expected inflation numbers, the Fed speak, the Fed meetings, they've all kind of shifted the fundamental picture and the narrative quite a bit. But also positioning is a big part, and investors, I think, the consensus expectation coming to the fall was so bearish, right? And that's why markets, I think, really had a hard time selling off in September, October. It was, the volatility was not on the downside. It was in the rally in November that we saw the sharp moves to the upside. That tells you the pain points is really markets going higher. And you saw that also in the derivatives market. Option volumes picked up in November. And I think CPI day, we had a record single day volume in S&P, 4.4 million contracts. It was dominated by the calls, right? And particularly longer dated calls expiring year end, December expiry. That tells you people were really managing their risks and adjusting their portfolios very dynamically and really concerned about hedging that right tail. Institutional investors who have underperformed all year, right, would not position for this rally, kind of sharp rally going to year end. We're scrambling for those upside calls. And you can see it also in, for example, like S&P put call ratio falling to a 1 year low in November. And also, various measures of skew in S&P and Russell all flattening to the lows, tells you really that the scramble is really for that upside exposure because people were not positioned that way.
I think it was sort of, I think I referred to it as weaponized FOMO. The thing is, if you're an individual investor listening in on this, FOMO is really greed, actually, because you're not really, your fear of missing out is really just, the greed aspect of it, or your idea of missing a move, and that's regrets. But if you're an institutional investor, FOMO is real, and it is fear, because you can't afford. No institutional investor wants to go into year end by underperforming his or her benchmark, or by being in the lowest decile, quartile, whatever. And so when that rally hit, no one wanted to be caught off guard, especially because the change in sentiment was so abrupt. And I think the statistics you highlight point to that. And I love the fact that you pointed out the year-end SPX volume, because I think it's very easy for a lot of people to say, oh, you know what, everybody's playing the SPX, zero-dated options, and that's all they care about. But that's the fact that you saw high volumes going into year-end told us that's institutional. That's institutional investors needing at least some upside coverage, and needing it in a hurry.
Exactly. Yeah. So I would say, obviously, zero-day options have seen the highest amount of growth, given that it's a relatively new product. But oftentimes when people talk about the growth in zero DTE, the narrative kind of there's a tendency to talk about it as kind of detracting or taking away from other tenors, and that's not at all what we've seen. We've seen kind of the entire pie grow, right, for SPX. So, volumes growing across all tenors is just it's growing faster for 0 days, and so I think that's something worth highlighting. And then to the point of if you look at what is really driving volume growth outside of 0-day options, I really tie it to the macro backdrop in a time of elevated uncertainty with regard to the inflation and the growth backdrop. Investors are turning more to options to kind of help manage both volatility of their portfolio, but also to really quantify kind of the risk reward of taking a directional view, right? If everything's clear and for sure market's going up, you would just buy the underlying, right? Yep. But it's when you're unsure, when there's a lot of risks out there that that could derail your view, that's when you turn to options, because going in, if you buy a call option, what you're at risk if you're wrong. It's just premium paid. So I think that part of option trading really appeals to institutional investors as well as retail during periods like this, where they need, I guess, more clarity and better tools to manage the volatility of their portfolio.
Yet at the same time, while that is really the use case for options, and you've articulated it wonderfully, it's reflective of greater uncertainty, yet when you look at other measures, as we go back to the volatility indices, they're not reflecting a lot of uncertainty. It's a very strange dilemma, conundrum, oxymoron. Yeah. I'm not sure what word is the right one here, but I think that's an interesting part of it.
Yeah, for sure. I mean, it's, I wouldn't say every part of the volatility curve is low, but certainly the front end of the curve, as we discussed, the lack of demand, or the lack of pricing for downside risk in the near term certainly stands out right now in terms of what is being priced in.
And excuse me. And without going down too deep down the zero DT rabbit hole, because I think you and I could have a higher level discussion than that. It's interesting. One thing I just want to point out to the listeners is, I focus a lot on the popularity of the SPX index option itself, because what I love about that, and I was on a panel with your colleague Henry Schwartz, Mandy, where we discussed the same thing, and the question came up, why is everybody so in love with SPX all of a sudden? And I love the fact that all types of option traders, investors, have woken up to the benefits of cash settled options. That you go home, you don't have to worry about assignment risk, you don't have to worry about pin risk. You're just, money changes hands, and as long as you're well capitalized enough and your brokerage firm has done a good enough job maintaining your margins, that's it. You just settle up at the end of the day and count your winnings or your losses as need be. Am I putting words in your mouth, or because you're
preaching to the choir for sure. Okay. I mean, that's definitely a huge benefit to trading index options. And I think when we talk about, obviously a popular question that we get is will we see zero DT options on other underlyings? I think the assignment risk, the settlement risk around physically settled options, that's going to be something that people need to figure out in order for it to really broaden out. But specifically with cash settled 0-day option trading, one of the things, you like to emphasize, especially when people talk about concerns around, 0DT trading, Volmageddon. I think we've gotten past that concern. I think at this point, people understand 0DT options enough to realize that is an overblown headline. But, one of the things that, I do push back on is that unlike what we saw in 2017, going into 2018 Volmageddon, where a period of very low volatility let all these inverse VIX ETFs really build up leverage. 0-day trading, the risk resets every single day. You don't get that buildup of leverage over period of days, weeks, month, or over a course of a year. So when you talk about like Volmageddon and leverage, it's a very different environment and scenario now versus what we saw in 2017, 2018.
I do feel bad for the third panelist on that panel because he was one of the guys who threw out the Volmageddon argument, and Henry and I kind of basically said back to him what you just said is, history rhymes, it doesn't repeat, and I don't see my you're not going to like this analogy, your colleagues aren't going to like the analogy, but I said that in the very beginning was that 0DTE options, it was really the casinos open more tables. And I know you do not have to do not comment on that because I don't want to get you in trouble. But basically, there were no new games invented. It was, they just opened a lot more $5 blackjack tables, so to speak, instead of inventing some game where no one knew the risks and no one knew the outcomes. I don't want to go too deep down the 0DT, place because you and I could talk about other stuff beyond that.
So I would say for people who are using options to speculate, certainly that analogy, is fitting. But I would say, and this is something that we've been trying to hammer home, is that the activity that we're seeing in 0DTE is actually very diverse and very balanced. And that's because there are different use cases, of diversity of use cases for 0-day options. There are people buying it to speculate. There are people buying these options to hedge, right? Either event risk, overnight risk, intraday risk. But also there are a lot of people selling these options, right, for income, for yield. So because it's so balanced, because it's not just speculators, right? Speculators, hedgers, momentum chasers, reversion, people playing for reversion, because it's so diverse, at the end of the day, when we look at like the net risk across different strikes of these 0-day options, it is extremely balanced. And I think that's why, a lot of the headlines are overblown because they assume that the notional volume, the notional risk is what you should be looking at when it's the net. And they assume that all the activity is one direction, which leaves, market makers obviously exposed on the other side, when in reality, the activity is actually very balanced.
Agreed. I'm going to change gears entirely. We'll get off this topic and onto one that I found to be an eye opener when you and I talked a few months ago, and we start. You brought up the topic of low volatility readings partially being influenced by by correlation or lack thereof, and at the time, and one of the things that I hadn't really appreciated before our discussion. I knew the mathematics of it, and for those listening in who didn't hear the first time, simple thing being, if you have an index and half the stocks go up and half the stocks go down, when you calculate the index, it didn't move, oversimplifying greatly. And if you have high correlation and they're all moving in the same direction, one way or the other, that's higher. That increases the volatility, oversimplifying. But I really wasn't aware of the various indices that the Cboe had in its suite. COR1M being my favorite because it's the same tenor as VIX. But you teased at the time that you had some new stuff in the works. And sure enough, like a week or two later, you guys introduced DSPX. And so what I would like to do is for you to sort of compare and contrast the various correlation and dispersion indices that you have in your product suite.
Yeah, sure. So maybe before I can compare the two, let me just quickly go over what is dispersion and what is correlation, right? Because they are related but different concepts. So dispersion at its core kind of measures how stocks are moving relative to each other. So you can think of it as like a measure of idiosyncratic or fundamental risk in the market. And I would say particularly if you are a equity long short investor or a stock picker, dispersion is something that you want to track because it measures how much stock picking alpha there is to be had, right? In a high dispersion environment where there's a lot of differentiation between stocks, right? A big spread between best performing versus worst performing stock, that's when it's most attractive to be a stock picker, when there's, the big movements and between winners and your losers. Whereas in a low dispersion environment where there's not much differentiation, well, you might as well be a passive index investor in that scenario, right? Because there's not much alpha to be generated from stock picking. So dispersion is an absolute measure of how kind of stocks are moving relative to each other. Correlation, on the other hand, is a relative measure of kind of how stocks are moving, but it's relative in that it doesn't really measure the magnitude. So that's where stocks could all be moving, could be all be selling off today, but it matters how much the individual stocks are moving, right, relative to each other. So you can definitely have situation. I think that's where people kind of get a little bit confused, is that conceptually you think dispersion and correlation are inverse of each other, right? High correlation must mean low dispersion, vice versa. But actually, there are often times where you get high correlation, high dispersion, and high VIX. So that's, for example, as what we saw in March of 2020. And the kind of the best way to think about it is that all of these measures are measures of risk in the market. And when risk is high, whether it's macro market risk, whether it's idiosyncratic risk, right, it's going to impact all of these indices at the same time. So to me, like having dispersion and DSPX index is complementary to the existing indices we have out there, for example, VIX and Core 1M, as you mentioned, because it really kind of completes the understanding of what is going on in the market, how much of the risk is coming from individual stocks versus the macro, the market level, how much are stocks moving relative to each other versus the index.
Yeah, because one of the reasons I've not yet been able to come up with good signals, DSPX versus VIX. While I have been able to come up with some, and those who suffer through reading my stuff every day, I've seen this before, is I've found that COR 1M has given me some good signals, particularly in September when the correlations started to return to more normal levels, having been very low. Yet VIX was just mired along, and then all of a sudden, boom, they caught up to each other, and that is what we're seeing now. We'll see if we go 2 for 2 on that one, but I've yet to really come up with a good way of I hate to use the word correlating, but coming up with a signal that links together DSPX and something a bit maybe a bit more tangible in terms of trading one vis-a-vis the other, using a signal as DSPX as a signal for VIX or some other volatility type of trading.
Yeah, so to me, it's like I think of it as a complementary measure to the VIX because it can tell you really what is driving the VIX, right? And I think the piece that I published around the SPX, the example that I used was in 2018, right? We had 2 big VIX spikes that year, Feb 18 and then Q4 of 2018, right? In both cases, VIX spiked, over 30, similar magnitude of moves, but what was driving the VIX was very different, right? In Feb of 2018, DSPX actually fell to 0, right? So at the time, if you had DSPX on that day when VIX blew up and the VIX ETNs, the blew up, you would have told you it was a technical index-led move that had no bearing on underlying fundamentals, right? Single stock option didn't see a similar bid, right? And volatility that we saw at the index level, there was very little fundamental risk that was being increased in the market. Whereas in Q4 of 2018, it was, dispersion actually, DSPX actually started rising before the VIX, and it was going, it was rising alongside the VIX. That was a period where the VIX was going higher because of increasing fundamental uncertainty with the market. With, I think at the time it was, Trump trade wars. There was, Powell monetary policy uncertainty. I think it was a lot more hawkish than people expected. There was, angst around earnings. Q4 earnings that year was, particularly bad, or there was a lot of uncertainty around that. So that was very much a fundamentally driven market sell-off, whereas kind of Feb 18 was a technical index-led move, and having DSPX alongside the VIX would have been able to kind of discern the two much better. And one of the things I think what's interesting that's been going on recently is that VIX has fallen a lot and DSPX, relatively speaking, has been more elevated. Now, it fell a lot in November, partly due to seasonality issues. But I would say overall, if you look at the average kind of over the past couple of months, DSPX has been a lot more elevated than the VIX. And this has kind of been true for the past 18 months. And it's really a reflection of the fact that a lot of the macro risks that we're talking about are having disproportionate impact at the sector. And the stock level rather than at the market level, right? So when we talk about higher rates, right, what that has kind of resulted in the equity market over the past 2 years has been these huge swings in growth versus value, cyclical versus defensive stocks, old economy versus tech. So we're seeing big swings at the sector and the single stock level, but because of low correlation, like we discussed last time, right, it hasn't really translated into higher levels of index volatility.
Excuse me. Yeah, I think that's also interesting, to unpack. We've all sort of heard the 7 versus 493 argument, but it is a lot more. It is a lot richer than that. And do you plan, without revealing any proprietary secrets, do you plan on expanding the suite of dispersion indices over the coming times? Or is it just, let me phrase it differently, is that something you're looking at doing based on what you've seen the adoption of this DSPX so far?
Yeah, so this is something that we're definitely going to be building upon. So right now, all that is out is the DSPX index, which is not tradable. It's meant to be an indicator very much like the VIX, but our plan is sometime next year to launch actually futures on the index, very much like VIX futures on the underlying VIX index, that will allow investors to actually express a view on future implied dispersion. Actually, let me, in case it wasn't clear to anyone listening, so DSPX, like the VIX, is a measure of forward-looking dispersion, implied dispersion, how much stocks are expected to move relative to each other over the next 30 days. So you'll be able to, once we launch the futures, be able to trade that level, similar to kind of how people trade VIX futures. So that's something we're very excited about. So look, stay tuned for that.
Because that I think would be a very interesting type of trading where you could trade DSPX futures versus VIX futures and see how those curves set up, because as you alluded to earlier, that longer term volatility is much higher than shorter term volatility. There's a certain steep, I find the VIX curve right now to be very steep. Some of it is strictly positive contango.
Yeah.
Let me unpack that for those who are not futures traders. That that in the longer, that as you look at a curve, it slopes up left to right. Some of that is interest rate effects. At some level, it affects the relative plentifulness versus scarcity of the underlying commodity. And in this case, one of the things it tells me when you see a very steep VIX curve is the commodity in question is available volatility protection. And as of now, it is quite plentiful and easy to come by. When you see the VIX curve invert, think about when that happens. It's usually in times of stress, and that tells you that there is a scarcity. So sorry, so that was not for you, Mandy. That was for all the others. But I think it's important to keep those frames in mind, and I think it'll be fascinating to see how a DSPX curve sets up with what is a normal contango for that curve. How will that be?
No, absolutely. You've touched upon something that that we're very excited about. One of the things we're excited about DSPX futures launching is that we think it will trade with a little bit of different curve and relationship versus the VIX, because as we all know, VIX typically is upward sloping, right? The futures curve and contango, as you just explained. But think about DSPX and forward-looking dispersion. A big part of what drives stock dispersion, actually, the most reliable catalyst is earnings. Right. So as we go through earnings season, that, you would expect to see more backwardation in the DSPX futures curve than you do for VIX. And what does that mean for carrying a long dispersion position, right? Versus, a long vol VIX position? It should be, when it's in backwardations, obviously the carry cost is a lot lower. So, there are definitely, I think, going to be a lot of nuances between DSPX future trading versus VIX trading. And that's something we're very excited about for next year.
Well, I think we've just set up a time frame for our next discussion if we don't do it sooner, because I can't wait to have it then. I'm just sort of getting the thing on my screen that we've blown through the time that we've had allotted to us, which I think is great because it means you and I have just been chatting away. And I as I've said, I enjoy our conversations immensely. So I think unless you have anything else to add, Mandy, I think we're going to wrap it up here. And again, I want to thank everybody for listening. My guest today has been Mandy Xu, Head of Derivatives Market Intelligence at Cboe. I am Steve Sosnick, Chief Strategist here at Interactive Brokers. You could find all our podcasts at IBKRpodcast.com and on your favorite podcast source, whether all the usual suspects. And we hope to see you soon. And Mandy, what a pleasure talking to you as always.
Thanks, Steve.
Take care, everybody. Bye-bye.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about Interactive Brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page. Complex or leveraged exchange-traded products are complicated instruments that should only be used by sophisticated investors who fully understand the terms, investment strategy, and risks associated with the products. Learn more about the risks through the link found in the show's notes or podcast description page.